Well, let's take a look at how the Kenyan market has fared for the day, and just checking in on that blue chip index. You're looking at a 0.5% gain, 4,788 points. Recovery there, albeit of course from a downward slope that we have seen, of course, in the markets for the past few trading sessions. And of course, the shilling has also been stable and strong. 83.75 is where it's trading against the US dollar. You're looking at a marginal dollar strength, just over 0.1% stronger right now, but certainly still below 84 against the US dollar, and of course ahead of that central bank meeting next week. And we'll take a look at that and more. We're crossing to Nairobi right now. Our Kenyan market watcher today, Ted Macharia, investment analyst at AIB Capital. Ted, thanks for joining us. So let's firstly start off with inflation and the implications for monetary policy going forward, because of course the countdown now to the next monetary policy meeting, which takes place next week. We saw inflation coming in yesterday, a slight, ever so slight tick up. It's certainly below the 5% inflation target or inflation band. I mean, what are your thoughts right now on how that is likely to influence their decision next week?
Thank you for having me on the show. Inflation is at 4.14 from 4.11. It's been very stable in the past 3 months, and I think the Monetary Policy Committee will be looking at that as an indication to perhaps ease the monetary policy. We're maybe looking at a rate cut of about 1% from 9.5 to 8.5. And the purpose of this would be perhaps to stimulate the economy more and to have cheaper credit flow down to the lower ends of the economic class. I think, however, they might also decide to hold it as it is and see how macroeconomic climate pans out, considering that we have a new government in power, and we might have some new policies coming into place.
Looking at how banks are benefiting from this low interest rate environment, just looking at NIC Bank and Housing Finance first quarter numbers, certainly indicating that those low interest expenses is helping them leverage off that and grow their loan book. Do you think that this is a trend that is going to continue? Do you think that other banks are also benefiting in the same way?
Yes, the banks are the first ones to cut the interest rates on deposits. They cut that before they cut the interest rates on loans, so that at least they can maintain decent net interest margins. I think perhaps the greater story we are seeing in the quarter earnings is the drop in loans and advances to customers, and also in the customer deposit base. That might be perhaps an element of the economic cycle, but it might also just reflect what has been happening in quarter one, that loan uptake reduced, and that customer deposits also reduced on account of the general elections.
So do you see that trend continuing then?
Yes, I think all the banks that will be releasing their quarter one earnings will show a similar story. Year-on-year growth, quarter one 2013 compared to quarter one 2012 will show some 30-40% earnings growth, but the quarter-on-quarter story will show perhaps either slower growth or deceleration. Interest expenses will obviously fall, as they have, compared to 2012, because in 2012 the interest rates were extremely high, talking about the range of 19%.
Let's move on to some earnings out today. Crown Paints reporting a 15% increase in full year turnover, coming in at around 4 billion shillings. And overall, you're looking at 12% growth in pre-tax profits. Were you satisfied with the numbers that came through? I mean, in terms of course, also being a manufacturer, they've got those cost push pressures that they have to consider right now.
I think they've done relatively well, considering the construction sector grew by about 10% through the year 2012, and the 15% is slightly above that. Obviously, going forward, they're looking at very tight costs, and cost containment will remain a puzzle for them, considering the wage bill has gone up for a start, and electricity costs are also expected to go up. Fuel has become a problem in transportation of paint, so I think they have done well enough with the factors that were affecting the business.
That being said, I mean, you're still looking at top line growth outpacing bottom line growth, but still the company is looking to take advantage of, I suppose, growth in the region, of increased infrastructure spend, of construction that's taking place. Do you think that they're well placed right now to be able to benefit from that, and I suppose continue to grow that 4 billion shilling revenue line right now?
I think they are well placed. However, the barriers to entry in the paint business is very low, so we might see new entrants into the market, but they have the asset base to prop them going forward, to boost them in whatever endeavors they'll be looking at targeting, particularly in the hotel industry and construction industry. Real estate projects are coming up almost on a daily basis, so they have the space, they have the cash, but new entrants might spoil the game for them.
And just lastly, Ted, we saw that Uhuru Kenyatta increasing the minimum wage by 14%. And of course, manufacturers have a lot to say about this. Crown Paints is a manufacturer, but there are a lot of companies that are listed that would be affected by this. I mean, which are the companies that stand out for you?
The problem with the increase in the wage bill is that the manufacturers will see it as setting the minimum cap on wages above the economic trend. So market forces are playing below that figure that the president quoted. I think going forward, the whole manufacturing sector is looking at some problems, not just on the wage bill side, but also on electricity, because we're expecting some upward tariff reviews. And at the end of the day, that will make our products less competitive in just the greater Eastern African region. So the manufacturing sector looks set to get hurt by the increase in the wage bill.